about hedge funds, it's often very useful to think about how we manage the funds, similar to the way that someone would use tools in the shed and having a wide array of tools to use in managing money. So compared to long-only portfolios, in managing a hedge fund, we have a lot more that we can do because we have a number of tools that we can use in order to grow the portfolio and manage risk. So I'll go through a number of these tools that we have in our toolkit that'll enable you to see how we can create better returns for our investors and usually with lower risk. One of these tools that we have in our toolkit is the ability to short shares. Now the ability to short means that you can essentially make money when a share goes down. So if we think that a share is overpriced and we expect that the share price to go down, we can actually borrow those shares, sell the shares, and then the share price will go down if we are right, and we'll buy them back, creating a profit in the process. If you're a long-only manager, you cannot do this. If you don't like a share, you simply don't own it. So you don't necessarily make returns for your investors, whereas we can actually make returns and profits for our investors when we don't like shares. Another way that we can manage portfolio risk is by using a number of short positions that match or hedge our long positions in our portfolio, thereby reducing the overall market risk. So if markets go up or down, we can make money if our longs or the shares that we like outperform our shorts, the shares that we don't like. So even in volatile times like that which we saw in 2022, we were able to create returns from investors regardless of the direction of the market because our longs outperformed our shorts, creating alpha for investors. This specifically helps in uncertain macro environments where you don't necessarily want to have the whole fund in equities or take necessarily a risk-on position. Another fantastic tool as a hedge fund that we have in our toolkit is the ability to use derivatives. Now primarily we use derivatives to hedge our portfolio. Sometimes it's a very cheap and effective way to hedge overall market risk for your investors. And this enables us to have returns that are generally less volatile than the market or our peers. We've also used derivatives in the past to actually make quite a bit of money. In events such as COVID, where you see an environment unfolding where there's one specific catalyst or one specific risk event that can occur, you can use derivatives to essentially bet on the market going up or down. And you pay a very small premium for this, but the asymmetric return profile of a derivative means that you can make a lot more money than you can lose on a specific trade. So the use of pair trades or shorting was fantastic for us in 2022, especially when we looked early on in the year at the potential for a sell-off in the markets and a volatile environment where we didn't really know where the market was going to go. So regardless of the overall market, regardless of the overall direction of the market, we're able to create alpha for our investors by buying shares that we think will go up and shorting shares that we think will go down, and in the process not necessarily having to take on any market risk.